Hello, everyone. Welcome to the Felesky Flynn Tax Forum, Session 2. And my name is John Fuller. I'm in the Felesky Flynn Edmonton office. Just a reminder that we are open to hosting virtual lunch and learns for any offices or individuals that are interested in having a session with us. We'd be happy to set it up, so reach out to myself or any of the other lawyers at our office, and we'll be happy to do that. Just a reminder that these sessions, they're in small chunks and lots of information, so they're very high-level comments. And so if you do have any questions throughout the session, you can use the Q&A feature to ask any of those questions, and we can try to respond to them afterwards during the session. And if we don't get to your question, please feel free to reach out to any of us with your question directly. So just to let you know, we have quite a few attendees that are on today, and we welcome everyone to the session. Now, to look at the agenda for today, there's going to be 4 presenters. Myself talking about loss utilization and planning. We've got Tim Kirby talking on some tax-deferred transfer provisions, Stephen Miazga on some qualified farm property, and Rob Nielsen on some litigation information for you. So we'll jump right in and start my presentation there on loss utilization and planning. So as a high-level planning point, one of the things to consider doing is in this time that some of your clients may be struggling for some financing, that to consider finding ways to obtain financing through the CRA by way of a refund of income taxes. And so if there's some losses that are being realized, that there may be some planning opportunities to access those losses and convert those into some funding. So there's some planning that we'll talk about, and I'll go through each one of those on the separate slides here. So first off, what I need to remind everyone of, and most of you I'm sure already know, is that there are certain liabilities that are very important to keep in mind for your clients, and the one is a director liability. So any unpaid GST and source deductions are going to be liable by the directors personally in the event that they're not paid by the entity, and I'll just make the assumption that it's corporations that are your clients. Of course, it could be other entities forms as well. So the directors are not liable for unpaid income taxes, but they would be liable for unpaid GST and source deductions. And they're actually treated more like trust funds, funds held in trust on behalf of the CRA, and it's very important to be careful with regards to those liabilities and prioritize them being paid ahead of pretty much any other liability that the entity may have. The other thing is that there could be some personal liability for other debts of the corporation, and if there are personal guarantees in place, which is something that should be kept in mind at this time, in the event that there's some liabilities that couldn't be paid, that there may be a temptation to prioritize the liabilities that are subject to personal guarantees over other liabilities. But you have to be careful with regards to the preference of which liability that you're paying. One of the planning opportunities that we've considered in the past is to ensure that any debts that are secured by personal guarantees have a priority security over the assets of the company. In the event that there is a liquidation, that those debts get paid first before the other unsecured creditors get paid. And that then protects the individual from having to be liable for under their personal guarantees. Next, to keep in mind is Section 160 with regards to dividends and gifts to related parties. This is something that we see often where if there's individuals that are about to be subject to some liabilities, whether it's director liabilities or other creditors, that they tend to think that if they just gift their assets away to other parties, that they can try to avoid that liability. So Section 160 is one of these provisions in the Income Tax Act that says if a corporation, let's say, has a liability and there's some dividends being paid out, or an individual has a liability and they're gifting property away, for example, transfer of an interest in a family home to their spouse or to their kids, or gifting monies away, that the persons receiving those assets or gifts of monies will be liable for the individual or the corporation's tax liability in the event that they were the recipients of some of those assets. So dividends are particularly troublesome there that you need to keep in mind based on some of the planning. If you want to do some dividend sprinkling, of course, subject to the new TOSI rules, but instead of paying dividends in order to avoid the Section 160, assuming that they're reasonable, that it would be much preferred to pay wages as opposed to dividends. Next, we want to talk briefly about the Fraudulent Conveyances Act. So I was mentioning earlier that if you're prioritizing somebody's liabilities over someone else's, that there might be a chance that somebody could challenge who you paid first. But one of the things to keep in mind is some asset protection strategies that are commonly thought to want to be completed in order to protect the assets of a business. And this is an example. There's a case called the Abacan case back in 2009 in BC that I just wanted to mention briefly, and that's where there was a reorganization, and as part of that planning, there was a dividend paid out to a second corporation, about $18 million worth, a big amount, and it was in anticipation of future creditors. And so that dividend paid out, got into business, incurred some losses, and that dividend was ended up being accessible to the creditors of the original corporation, even though they were future creditors and not just current creditors. Now, we're not sure if that's actually something that has been utilized in Alberta or in Saskatchewan. There's a little bit different sets of laws against that or around that. However, we've been speaking with some bankruptcy lawyers, and they feel that it's still a risk that you must consider. So just as an example, just to show you a couple of illustrations there of what we're talking about, in the case of Abacan, there was a company that had other assets as well as the operations. And then the second slide, next one there, shows that there's option one and option two. Option one is what Abacan did, where they kept ACO where the operations were and shifted all the assets up by way of a dividend to a new company. However, the way to really protect your assets is instead having left the old company the way it is with the assets and simply transferred the operations or started the new operations in a new corporation. And that would have protected against the future creditors of the business. Next, just talk briefly about planning for corporations and individuals with regards to unrealized losses that they may have. So some investments have gone down in value in the stock market, for example, and there may be an opportunity to trigger some of those losses, assuming that there were some, say, capital gains in the past 3 years that could be carried back to obtain a refund of some of those taxes that were paid. However, there's a couple of rules to think about. One's the superficial loss rules, one's suspended loss, and there's a 30-day rule that you have to be mindful of. So before and after the event of the disposition, as well as on the 30th day after the disposition, you can't be holding an identical property. So those are some opportunities to keep in mind. Next, and this is a little bit of an extra step here for corporations that might be able to do some planning. And one, of course, is very important is if there's a capital dividend account that is held by the corporation, to pay that out before realizing any capital losses, such that then you can pay out some tax-free dividends. Another planning point could be if you have some unrealized losses and no capital gains, let's say in the past 3 years, that you could trigger some capital gains, create a capital dividend account, then pay out the capital dividend account, then trigger the unrealized losses, and you could offset the losses with the capital gains. In the meantime, you've created a shareholder loan with the tax-free capital dividend. Some thoughts there on how to do some of this planning. Let's say that you've got some bank shares and you want it to stay in that same kind of investment. Thought could be as you sell one kind of bank shares and then you buy another kind of bank shares, so that hopefully that risk tolerance will be about the same if it goes up or down, but you've actually disposed of that property and you've realized the loss. Next is with regards to the sale of real estate to a non-affiliated entity. We've had this before, which has been a plan whereby there's some real estate that's gone down in value and you want to trigger a loss in order to obtain a tax refund from the past. Is that then that entity disposes of the real estate to another corporation, but that other corporation must be not affiliated with the transferor corporation in order to realize the loss. And if it's a depreciable property, you'd be able to obtain a terminal loss. And there's other planning to consider, perhaps accelerating the taxation year end so that you accelerate the tax refund. And there are some ways to do that, and those are things to keep in mind depending on the timing of things and how soon you may want to have that refund received. Next, just to talk briefly about losses. If you have several corporations, your client has perhaps a company that's got some losses and some profits, and you want to ensure that the losses can be offset or have the losses offset the profits, then you may want to merge those two corporations together, and there's ways to do that by way of an amalgamation or a wind up. And there's some timing issues that you have to be mindful of, but there's opportunities to do that. Now, one of the things to keep in mind, and we get this question quite frequently, oh, I know this company has got lots of losses, why don't I just buy it? And then I can use the losses against my profits. And that is a very difficult undertaking to accomplish properly and to be able to use those losses. And so that's not what we're talking about when we're talking about doing this merging of corporations. The corporations must be owned by the same group there, and in particularly, you need to make sure that they are, if it's possible, being owned by the same group of persons. Next, we have transferring of property to a loss company. So you've got a company that has a property that's got an unrealized gain on it, and you're about to sell it, and you've got a company that's got some losses to offset that gain. There is a plan available to transfer that property on a tax-deferred basis under Section 85 that could transfer the property to the loss company and then selling the property by the loss company in order to then avoid the tax on that gain. There's some other rules to watch out for, being mindful particularly of subsection 6911, whereby the loss co and the hold co must be affiliated at the commencement of the series of transactions. So that's it for me today. And next, Tim Kirby is going to be talking about select tax deferred transfer provisions and reorganizations. Tim?
Thanks, John. Lots of excellent information there and lots of planning opportunities to keep in mind, that's for sure. Appreciate everyone coming out today, sharing a bit of their day with us to learn a little bit, hopefully. As John mentioned earlier, I'll talk about some tax-deferred transfer provisions. Then I'll move into some estate freeze and refreeze transaction ideas, and then look at the famous pipeline type of reorganization. Starting off with Section 51 share exchanges, it involves a shareholder exchanging shares or exchangeable debt for other shares of the corporation. The exchange shares have to be held on account of capital, so no inventory shares. And the only consideration that the shareholder receives on the exchange must be new shares. In other words, they can't receive any non-share consideration or boot. A few other requirements are that none of Section 86 or subsections 85.1 and 85.2 may apply to the exchange. And also, where the shareholder receives multiple classes of new shares, the ACB is averaged between those new classes of shares according to their relative fair market values. Interestingly, a share exchange under Section 51 is not considered a disposition for most purposes of the Act, meaning that no tax reporting is required if your exchange is under 51. Finally, price adjustment clauses are very frequently used in Section 51 share exchanges. A few notes on use of price adjustment clauses. The CRA's view is that unless bona fide efforts are made to determine the fair market value of the old shares, they will not respect the operation of a price adjustment clause. As such, it's always a good idea to have a case and maintain that case in your file for how you determine the exchange value. And then another note on price adjustment clauses: they may not be appropriate in all circumstances, particularly when looking at an arm's length purchase and sale transaction. In that type of transaction, both the purchaser and the vendor generally want some certainty as to the redemption amount of any preferred shares that are being transacted. Moving on to Section 86, the requirements are fairly similar, but with some key differences to a Section 51 share exchange. Firstly, the shareholder must exchange all of their shares of a class, whereas Section 51, you could exchange a portion of your common shares, for example, for some preferred shares. Again, the exchange shares have to be held on account of capital. And here's another difference between 86 and 51. While the consideration the shareholder receives has to include shares, they can also receive boot. That said, receiving boot on an internal transaction such as an 86 is quite uncommon, and you have to take some care there. There are some negative tax consequences if the boot exceeds certain limits. Section 86, it will apply if all the requirements are met, unless a Section 85 election is filed. So as you can see, there's a bit of a hierarchy. If Section 85 applies, then neither Section 86 or 51 applies. If 85 does not apply, but 86 does, 51 will not apply. So it's a hierarchy or ordering of the rules. To fit under Section 86, it must be a reorganization. The term reorganization, it's not defined in the Income Tax Act or under corporate law. The CRA has interpreted it as meaning a transaction is included in the series that requires the amendment of the constating article documents of the corporation. Most generally, most commonly, that involves filing articles of amendment. Similarly to a Section 51, where the shareholder receives multiple classes of shares on the exchange, their ACB gets averaged according to the relative fair market values. Section 86 does constitute a disposition for tax purposes, so they do have to be reported. Occasionally, a taxpayer won't fit within the Section 51 requirements, and that they might need to file articles of amendment to authorize preferred shares, but they like the non-reporting feature of a Section 51. So consider a simple example where you have a single shareholder owning 100 common shares, and they have to file articles of amendment to include classes of preferred shares for the share exchange. If they just take their 100 common shares and exchange them for preferred shares, then we're going to be under Section 86. So instead of doing that, consider splitting the common shares into a very large number of common shares before you exchange them for preferred shares, and exchange all but one of the common shares. You've gotten virtually to the same place, but because you haven't exchanged all classes of all shares of the class, Section 86 should not apply and Section 51 should apply, meaning no reporting would be required. Again, similar considerations regarding price adjustment clauses as under a Section 51. Moving on to subsection 85.1, these are rollover transactions, and they involve transfer of eligible property to a taxable Canadian corporation. Now, it's important to note that eligible property for purposes of Section 85 does not include real property inventory. So this is very important in that if you try and roll land inventory into a corporation, you might have what you think is a tax-deferred transfer and turn that into a taxable event, making it for a very unhappy client. However, if they're very determined that they want land inventory to be moved into a corporation, they could take a lesson from a couple of brothers by the last name of Loyens. These guys got the idea that they wanted to move land inventory into their corporation, and they got the advice that you can't do it under 85.1. However, their tax advisors were pretty smart dudes, and they knew that Section 97 sub 2, it's almost identical to 85.1, but it applies for transfers of property into a partnership as opposed to a taxable Canadian corporation, and also that there's no prohibition on rolling land inventory under 97.2. Tax advisors also knew that you could roll partnership interests to a corporation under 85.1. So what the Loyens brothers did was they took the land inventory, rolled it into a partnership under 97.2, and then rolled their partnership interests to the corporation under 85.1, causing the partnership to wind up into the corporation. So they did two steps to get to the same result, which was a tax-deferred transfer of land inventory into a corporation. Obviously a bit more complex, a bit more work, but in the right circumstances and for the right client, it's something to keep in mind. Being mindful, of course, that there is a bit of an avoidance element to that type of transaction. Looking at the consideration that has to be received on an 85 rollover, a share, one or more shares, must be received for each asset being transferred on a rollover basis. For that reason, it's important that you take time to allocate the consideration between all of the assets being purchased. It is possible to receive boot on a Section 85.1 rollover. It is a little bit uncommon on internal transactions, especially where you're taking shares of Corporation A and exchanging them for other shares of Corporation A. And anytime you're transferring shares of one corporation to another on a non-arm's length basis and you want to take back boot, you always have to be very mindful of Section 84.1, which can convert a tax-deferred rollover, what you're thinking is a tax-deferred rollover, into an immediate taxable dividend. So always watch out for whether your cost base is hard or soft. A T2057 election needs to be filed in order to get under 85.1. The filing deadline for that, it's the earlier filing deadline between the transferor and transferee. Although it is possible to late file these T2057s within 3 years of their original filing deadline, provided the applicable late filing penalty is paid. That's generally $100 per month. In the election, you have to choose your agreed amount, and that constitutes the proceeds of disposition for the transferor and forms the cost to the transferee of the property. Most commonly, the agreed amount is equal to the tax cost, unless a gain is desired to be triggered. When looking at how the agreed amount gets allocated to the transferor, it first gets allocated to boot. So non-share consideration gets the first chunk of the agreed amount. Any remaining agreed amount gets allocated to preferred shares up to their redemption amount, and anything that's left goes to common shares received on the transfer. GST, when you're rolling property that isn't exempt, for example, you're rolling tangible property and there's no exemptions, so no GST 44, no closely related exception. GST will apply based on the fair market value of the property transferred, not based on the agreed amount for income tax purposes. Also, in Saskatchewan, PST exemptions will apply to most reorganization transactions. However, it should still be looked at when you're looking at any rollovers. Freeze and refreeze transactions. The idea behind a freeze is that a shareholder exchanges common shares for fixed value, redeemable, retractable preferred shares. The goal here is then to allow new common shares to be issued to other taxpayers for a nominal subscription amount. For example, if a founder wants to bring in a spouse as a common shareholder, family trusts, children, grandchildren, key employees. It's a way to shift future growth to different shareholders and potentially allow dividends to be paid to those other shareholders, being mindful, of course, of tax on split income, or TOSI, as well as some anti-avoidance rules and attribution rules such as subsection 74.4 sub 2. If a freeze was undertaken in years previous and there hasn't been any extraction of capital, such as dividends on the new common shares, and if the corporation's value has actually declined due to things such as terrible oil prices, COVID, other external factors, you might want to consider a refreeze. And what a refreeze involves is taking the old freeze shares that, say, you froze at $1 million and the company as a whole is only worth $700,000. You could take your $1 million redemption amount original preferred shares and exchange those for new preferred shares with a redemption amount of just $700,000. CRA is generally accepting of those types of refreeze transactions, provided that decline in value, again, isn't due to the extraction of capital out of the company, but it's due to external factors. And likewise, if you have a corporation that has had a very high value historically, but it might have come off due to those external factors, you might want to consider whether now is a good time to implement an estate freeze, which could be beneficial for mitigating tax on the founder's death, for example. Pipeline reorganizations. Pipelines aren't just for oil and gas, but they're also a tax-efficient way to provide a measure of creditor protection, as well as to keep operating corporations pure for future capital gains deduction use, without complicating corporate structures by inserting a holding company, and without having to worry about subsection 55(2) applying to any purification dividends that you may want to pay to a holding corporation. The concept behind a pipeline is intentionally triggering a capital gain in order to extract that capital to provide that creditor protection and capital gains deduction purification use. So to illustrate this, I thought I'd take you through one simple example. There are lots of different ways to do a pipeline, but this is just one that you'll see quite frequently. We have, again, a simple structure here. A single shareholder owns all of the common shares and also has 1 million Class A preferred shares with nominal ACB and paid up capital, so just $100 of cost base and PUC, and a redemption amount of $1 per share or $1 million in total. First step would be for the shareholder to exchange those Class A common shares for Class A preferred shares, I should say, for 1 million Class B preferred shares. So it's taking one class of preferred shares, exchanging them for a second class of preferred shares. It's important that there be some distinguishing features in the attributes of those two classes of preferred shares. And then they do it in a manner that actually triggers the capital gain. Most frequently, it would be through an internal 85-1. So in that case, your elected amount would be $1 million. That's going to give rise to approximately a $1 million capital gain to the shareholder. And this is critical that they pay tax on that capital gain and not shelter the capital gain with their capital gains deduction. By paying tax, that adjusted cost base, that $1 million adjusted cost base, should be hard for purposes of 84.1. Next, the shareholder takes those $1 million of high ACB preferred shares of OpCo and sells them to HoldCo in exchange for approximately $1 million of shareholder loan. And I say approximately because we like the shareholder to take back a common share. That lets us maybe back into an 85 rollover, or if there's a value dispute, we can rely on a backdated Section 85 election. We also like to include a debt adjustment provision just in case there's some uncertainty as to whether cost base on the transferred shares was hard for 84.1 purposes. So again, the only tax that gets paid here is at the individual shareholder level at capital gains rates, which can be compared to if they'd pulled out $1 million dividend as eligible or ineligible. It creates a nice bit of tax savings there, in addition to achieving those commercial objectives. Other circumstances you might want to think about is an intercorporate pipeline. Here again, just a very simple structure. We have a single individual shareholder owns all of HoldCo, and HoldCo owns 1 million Class A preferred shares with, again, very nominal ACB and PUC and fair market value and redemption amount of $1 million. Here, instead of the individual shareholder realizing the capital gain, Holdco will do a similar capital gains realization transaction where they exchange their Class A preferred shares for 1 million Class B preferred shares. Do it on a taxable basis. So Holdco is going to realize that capital gain, have an addition to its capital dividend account, as well as have corporate tax liability at most likely investment rates. So there'd be an addition to RDTOH. And then next step, Holdco pays out capital dividends to the shareholder, which of course are tax-free, as well as taxable RDTOH recovery dividends. Net result here is Holdco realizes capital gain, and the net tax effect is Holdco has the remaining corporate tax after recovering the RDTOH, and the shareholder pays tax on a portion of the dividends as taxable dividends. So corporate capital gain, slightly higher tax than individual capital gain, but certainly something to think about if you're in the right circumstances. So with that, I remind everyone about the Q&A function. So if you have any questions from this, please fire them in and we'll try and get to them at the end of the presentation. Thanks for your attention, and I'll turn it over to Steve, who will talk about the capital gains deduction.
Thanks, Tim. So as John alluded to at the start, I'm going to spend a little bit of time talking about the capital gains deduction in a specific farming context. And while I named the presentation Accessing the Capital Gains Deduction, on reflection, it probably would have been more appropriate to title it Monetizing the Capital Gains Deduction, because as we'll see over the next 15 minutes or so, it's very easy to access the capital gains deduction, specifically if people have personally held farm property, but it's a little bit harder to actually monetize the capital gains deduction into something that will let you extract cash out of a corporation from its small business deduction rate tax retained earnings. So before we get into some of the planning scenarios, we probably need a little bit of background here. So in the farming context, the capital gains deduction can be accessed on two things. One, qualified farm or fishing property, which we'll call QFP throughout the presentation, and two, shares of a qualified small business corporation. I'll note that the limit for qualified farm property is a little bit higher than the QSBC limit right now, though because the QSBC limit is indexed to inflation, eventually that gap will close. There's a bunch of reductions to the capital gains deduction limit that exist that are way outside the scope of the presentation today. When we talk about qualified farm property specifically, there are four broad areas that are included within QFP. First being farmland that's personally held by individuals, then shares of family farm corporations, interests in family farm partnerships, and property that's included in class 14.1. So really we're talking about dairy and egg quotas here primarily. Before we move on, I should probably mention that anytime you're talking about accessing the capital gains deduction, it's worth mentioning that AMT or alternative minimum tax needs to be considered. So if you have clients that are looking at implementing the kinds of transactions we're going to talk about this afternoon, you should consider alternative minimum tax, because the last thing anybody wants is a client that has been told that they'll get $1 million out of their corporation tax-free and ends up with a tax bill when they file their personal tax return because of alternative minimum tax. Talking about plans, we're going to talk in two broad categories today. The first being ways to access and then monetize the capital gains deduction in a related party context. The second being how we are going to look at monetizing that capital gains deduction in transactions involving arm's length parties. So in the related party context, let's maybe start with the very basic example to begin with. So here we have an individual farmer that owns farmland that conveniently has an unrealized gain in it worth exactly the $1 million capital gains deduction limit. And in order to access that capital gains deduction, the farmer is going to simply sell that land to their corporation for a $1.1 million credit to their shareholder loan account. So why does this work here when in a non-farm context, anyone is going to caution you about accessing your capital gains deduction with yourself or other related parties? Simply, that's because Section 84.1, the provision Tim alluded to earlier, creating problems with transactions where you don't have hard cost, only applies to transactions involving shares and bare land that consists of QFP, or interests in partnerships that consist of QFP that we'll see in a few minutes aren't caught within the scope of 84.1. So you can implement some of these transactions on a related party basis. While selling land to a corporation makes it easy to monetize the capital gains deduction, it does really restrict that individual farmer's ability to be flexible in estate and succession planning later, because we now have land that was previously in his personal name, now trapped in the corporation, and estates aren't going to be as easy to equalize that way. Another option to access the capital gains deduction is simply accessing it when farmland is transferred to the next generation as part of an either inter vivos or post-mortem succession plan. And generally, if you're looking at these types of transactions, it's easier to access the capital gains deduction here on the death of a farmer because alternative minimum tax isn't going to apply. However, while this is, achieving our objectives of it's easy to implement the transaction this way, and flexibility is going to be maintained in the farm because the land is still held personally when it's transferred from parent to child in a way that triggers the capital gains deduction, not the intergenerational rollover. I'm not a huge fan of these transactions. Due to the economics of simply accessing the capital gains deduction by creating tax cost in an asset. So in a really simple example, like we talked about earlier, we have property being transferred from a parent to a child. We use our $1 million capital gains deduction and create $1 million of cost base in that land. If the child is going to continue the farming operation and not sell that land, you're not going to be able to access the tax cost in that land until the child is either ready to A, sell the land to a third party, or B, move it into a corporation in a transaction similar to the one we talked about earlier. Because I like to talk about math a reasonable amount, to illustrate that example a little bit, if you say we're not going to sell that land for 50 years because we're transferring it to a child who's going to continue to run the farm indefinitely, the present value, using a 5% discount rate, of the tax benefit of the $1 million capital gains deduction in 50 years is a little bit under $21,000. So while capital gains deduction is easy to access here, the economic benefit isn't that great, so we should look for another way to access that capital gains deduction. I think a good way to do that is through partnership interests. So while there are a lot of ways to access the capital gains deduction for qualified farm property, dealing with partnerships, the little example I have here is a common one you'll run across where a husband and wife are already farming through a corporation, accessing the small business deduction, but haven't used their capital gains deduction yet. So to start, we're going to form a partnership between the farm co, the husband, and the wife. We want to get some farming assets into the partnership, which we can do on a tax-deferred basis, relying on some of the rollover rules Tim spoke about earlier. And from there, we are going to have to do two things. The first is we're going to have to let the partnership sit around so an interest in it qualifies as qualified farm property. So to do that, we are going to need to make sure husband and wife hold their partnership interests for 24 months. The second thing we are going to want to do is either A, get enough value into the hands of husband and wife's partnership interests such that $1 million gain has accrued, or two, have husband and wife draw property out of the partnership to push their ACBs in that partnership interest negative in a way that selling them to the farm co will trigger a $1 million gain. Once we've done those things, we're going to have the husband and wife sell their partnership interest to the farm corporation in exchange for a promissory note. Once that sale is done, the partnership is going to wind up automatically by the operation of law, and that wind up is going to occur on a fully tax-deferred basis under subsection 98.5 of the Income Tax Act. And we'll see once it's wound up into the farm co, we're back to where we started in their organizational structure, except the husband and wife now have $1 million shareholder loan credits each and have used their full capital gains deductions up. I really like transactions like this because it will allow us to actually monetize the capital gains deduction, not simply create cost base, but also will not result in any permanent changes to the farm structure that will make estate or succession planning more complicated or undermine existing plans that are in place. So I now want to spend a few minutes talking about accessing the capital gains deduction in non-related party or arm's length transactions. So in an arm's length context, we now have an additional tool at play to access the capital gains deduction because we can sell shares of a farm corporation to a third party's corporation and not worry about the application of section 84.1. So as you'll see in my first example there, selling land from an individual to a third party is still going to work just like it was in our very first example to access the capital gains deduction. But in my second example, selling shares of a farm corporation to a third party, or more commonly, a third party's farm corporation, is going to be another viable way to access the capital gains deduction. When we talk about accessing the capital gains deduction on farm corporation shares, the figure B example makes it look relatively easy. However, in most cases, it's a little bit more complicated than that because farm corporations tend to own things other than the farmland that buyers typically want to get at. So we are going to have to look to a transaction structure that will bridge the vendor's objective to sell the shares of their farm corporation to access the capital gains deduction with the buyer's objective of trying to only access the farmland they want to acquire to get high tax cost farmland inside their corporation. So what planning can we do to bridge those objectives? We'll look at a really simple example here that is going to involve two steps of one, we are going to have to implement a pre-closing reorg on the vendor's side of some sort to get the target asset, that farmland with low tax cost, into a separate entity. We can do that in two ways. One, we can transfer the farmland from the existing farm co into a new corporation, or two, we could transfer all the other non-land assets out of the farm corporation somewhere else and sell the shares of the existing farm corporation. which of those options we take is really going to depend on a multitude of very fact-specific things, including what the other assets actually are, how far out we think we are from a sale, what safe income inside the farm corporation is. But there, just suffice it to say for now, there are a lot of scenarios that will let us get here. Once we get our sale corporation set up only owning the low tax cost land, we can sell the shares of that corporation to the buyer's corporation, access our capital gains deduction on those shares, and the buyer can then amalgamate the corporation it purchased with their existing farm co and bump up the ACB of the farmland to fair market value using the bump provisions in 88(1)D on, what is likely going to be a wind up in Alberta or an amalgamation in Saskatchewan, because we want to avoid land transfer tax. So with that in mind, I think I'm going to turn it over to Rob to talk about some tax dispute issues and bring it home for us here. Thanks for your time.
All right, Stephen, thanks so much for that introduction. I appreciate it. I believe I remembered to turn my mute button off, so I've accomplished what I wanted to today, so that's good. And in addition to that, what I'll do is I'll provide a quick update on disputes, which, as you may have guessed, are not a particular front burner here with the COVID lockdown and all that good stuff. But I will touch on some things with respect to the CRA, being audits, objections, collections, and what they've said so far. I'll talk about the courts that we normally find ourselves in, tax court and the federal courts, and I will talk about an interesting piece of proposed legislation called the Time Limits and Other Periods Act, COVID-19, which I think you will be interested to hear about. And then lastly, at the end, what I'll do is we will take some questions, time permitting, of course, and I will throw those questions out to the appropriate person. So moving on to the first part of my presentation, the CRA and audits. So as you may already know, most audits since about mid-March have been essentially suspended and held in abeyance. Now, there has been some exceptions for certain files, and we've seen a little bit of activity around audits where there was a statute bar date approaching. But for the most part, they have been shut down. And so late last week, the CRA actually updated its website to advise that it's resuming its full range of audit work, whatever that might mean. So I assume what that means is that we will be hearing a lot more from auditors in the near future here. Now, they have indicated that they're going to give priority to higher value audits, audits that are close to completion, and audits that they consider to have strategic importance for the government. So probably your project audits and that sort of thing. And one interesting bit that actually came out of that as well is the CRA indicated they'd be changing some of their procedures in light of recent events, and that they may begin to use email. So for some of us who've been dealing with the CRA for quite some time, I think the use of email by them is going to be very exciting. So then moving on to objections. Now, unfortunately or fortunately, depending on your perspective with respect to objections, all objections are still being held in abeyance with a couple of exceptions. And so the exception is objections that are related to an entitlement to benefits or credits. Those ones, the CRA says it will consider to be of strategic importance. And so presumably, if you have an objection like that, you may be hearing from them in the near future. The other thing to note about objections, of course, is that there is an administrative concession the CRA has made where basically if your time to file a notice of objection under the Income Tax Act or the Excise Tax Act, if that time falls within the sort of COVID period of mid-March to June 30th, that the CRA is going to administratively extend the time and allow you to file that objection late. So that is important to keep in mind as well. In terms of collections is suspended I haven't heard from collections personally since this all began, which is good, and I'm sure my clients are very happy about that as well. So the CRA said they're not going to take any actions on new debts. They've said that payment arrangements are available, and they've given a number to call them just in case you really want to pay the CRA. You can probably dial that number and come up with a way to do it. So just one thing of note, there has been some discussion about what would happen in the circumstance where somebody filed a GST return, it shows GST owing, but that maybe that corporation is in line to get the Canada Emergency Wage Subsidy as well. And so CRA has said that they're not going to claw back those CEWS payments in those circumstances. So that at least is some good news. In terms of the tax court, which is the court where I predominantly spend my time, there is a suspension period wherein basically all of the deadlines under the rules of court and any timetable orders that the court has made have been suspended starting March 16th, 2020. And so the end date for that suspension period is going to be 60 days after the court opens, which unfortunately is a date uncertain. So there's no indication yet of when the court is going to be able to open. And I'll talk a little bit more about that when I talk about a recent webinar that was put on by the Chief Justice. So in terms of actual court hearings and conference calls and stuff like that, those up to July 17th are all adjourned to some indefinite point in the future. And the court may resume hearings after that date during what's traditionally their 4-week summer break there. But it's all going to depend on what happens in terms of the staffing for the court. So maybe then that brings me right into the webinar that the Chief Justice gave not long ago, where he talked about some of the challenges the court's been facing in terms of reopening. And I think the key challenges, there's really two that he mentioned. One is that the tax court doesn't really employ its own staff. It's staffed by the Courts Administration Service, or CAS. And so without those employees, the tax court essentially cannot function in the normal way that it would. And the chief administrator of that service has essentially put in place a plan that involves the staff not working in the registries and the offices. So until that particular decision is rescinded or altered in any way, it looks like the court and certainly the registries will not be operating as far as the tax court goes. So in the meantime, we understand that justices are working on reserve decisions. So any decisions where there was a hearing before the COVID period and the court took away the evidence and the argument to think about what its decision was going to be, we're assured that the court judges are working on those decisions. So once they have staff in order to publish those decisions, I'm sure we will start to see those probably quite a few actually all at once. Now, the Chief Justice did give some indication about what's going to happen when the court reopens, and it's going to take some steps to try to alleviate the backlog that's been created by this delay, the suspension period. One of those factors, 2 duty judges are going to be available to deal with motions and that sort of thing. The Chief Justice indicated he's going to add additional judges' sittings to the docket for all of his judges, which there was no word about what the judges thought about that, but I'm sure everyone's on board. And then lastly, the one thing to note that I did want to point out is the tax court for this year at least is going to limit its sittings to the larger centers. And so essentially what that means is if you want to have a tax court hearing in Vancouver, Calgary, Edmonton, Toronto, Montreal, Ottawa, then you're going to be in luck. And if you're in any other center than that, you're probably either going to have to wait or you might be able to have your matter rescheduled in one of those larger centers. So in terms of the federal court and the Federal Court of Appeal, they've similarly had suspension periods in terms of the rules and that sort of thing. They've adjourned all in-person hearings. The latest date for which they might resume and the latest end date for the suspension period that's been proposed is June 15th. of course, is subject to change and depends on all the factors. These courts have indicated that some of their matters might proceed, and they've suggested that there might be a way to have your matter heard and disposed of with respect to using written submissions. But I certainly haven't had any contact with the court in that regard. And I do wonder, you know, how many people would be interested in giving up their day in court, I guess. So we'll have to wait and see if that's actually a thing that happens. I will say that unlike the tax court, the federal court and the Federal Court of Appeal have been issuing decisions. So they at least have that ability, notwithstanding that they have the same administration service of the tax court. And so the last thing I want to touch on before we get to questions here is the Time Limits and Other Periods Act, this proposed legislation. It would do a couple of things. One, I think that taxpayers will be happy about, and the other, which I'm pretty sure they won't be happy about. So the first thing that this proposed legislation would do is it would give courts the power to extend federal, like statutory deadlines that are in federal legislation. And so, for example, if a particular statute gives a taxpayer 90 days in order to file something, this legislation would give the court the power to extend that date, you know, on its own motion, essentially, given the COVID lockdown. So that's kind of the good thing, I guess. And the suspension period that was proposed in the legislation would be March 13 to September 13 inclusive. Now, the other part of this legislation I think people are going to be less happy about, and some bottles of champagne might have to be recorked here, is the legislation would allow the Minister of National Revenue and any federal minister to extend certain time limits in legislation that they deal with. And so, for example, the normal reassessment period in the Income Tax Act and the Excise Tax Act is those provisions would be caught by this legislation. And so, in other words, if your matter were to go statute barred, for example, here during this COVID period, then this legislation would allow the minister to extend that date, the date that your matter goes statute barred, by up to 6 months. And so this could even happen retroactively, and the legislation as it's written to date says it's retroactive to March 13. So if your matter went statute barred on March 14, you know, it might be a little bit premature to celebrate. So our office has sent in a submission to the government about this particular legislation, but in any event, we will have to wait and see whether it goes forward as proposed. So then, that's my bit there. And turning to questions, let me just see here. I will throw a question to Tim. And the question is, given what you said about Section 51 exchanges and the need for there being no need to report anything, would an exchange, a transaction like that, go statute barred in the normal course?
Thanks, Rob. Excellent question. Now, it's the actual transaction year and applicable tax return that goes statute barred, not the transaction itself. So as long as the taxpayer had a reasonable position that Section 51 applied to the share exchange and didn't report it, that tax return should in fact go statute barred in the ordinary course, subject of course to Rob's comments on this uncertainty about the extension of the normal reassessment period.
Excellent, thank you, Tim. That was a great answer, great question. So next I have a question for Mr. John Fuller. And the question is, if the client is uncertain about their CDA balance, is there planning that would be available to allow for taking advantage of that by way of capital dividend before realizing a capital loss?
Okay, thanks, Rob. Yeah, actually, it's a good question. And it's one of those things that you don't know sometimes for sure if that CDA balance is solid. Sometimes what happens is that you may have a transaction in the past, and maybe this is the case, where it may be an account of inventory or an account of capital, If it's a sale of a property, let's say, and you're not sure if you should be able to be entitled to a capital gain. However, it's been treated as a capital gain and it's sitting there as a capital dividend account, but you've been waiting for a while. One of the things that we recommend is if there's a parent company above the corporation that has the capital dividend account balance, that to pay that dividend out to that holding company, in the event that there is a shortage of a capital dividend account, there's a way to make an election to create that the dividend to no longer be a tax-free dividend, but to be a taxable dividend, and it should be available, or at least you should have the opportunity to have that dividend received tax-free by the parent corporation. If there is no parent corporation there, then the alternative could be to transfer the shares into a holding company first, pay the capital dividend account out, and then trigger the non-cap or the capital loss. And then that way you have some protection, that dividend being received by a corporation, and avoiding the personal tax liability in the event that your capital dividend account balance is not sufficient to cover the capital dividend.
Excellent. Thanks for that, John. Great answer. Maybe we'll do one more question here, and then obviously if we haven't gotten to your question, just in the interest of time here, feel free to reach out to any of us and we'll be happy to answer it. And so this last question I think is for Tim. Tim, with respect to pipelines, are they still effective for shareholders of a PC, a professional corporation?
Thanks, Rob. And that's another very good question. Generally speaking, they are. You need to look at the PC legislation according to which jurisdiction the professional corporation is incorporated under. Different provinces have different rules based on shareholdings of PCs. For example, Saskatchewan has quite permissive rules, whereas Alberta is fairly restrictive. The restriction is that in Alberta, holding corporations of professional corporations are not typically permitted. That said, a lot of the different professional governing bodies will allow them to be in place for a moment in time. Different professional bodies approach it differently. For example, the dental professionals, they can get a comfort letter from their college that says, okay, if you do these transactions, we confirm that the college will not take any action against the professional corporation. And other governing bodies, for example, might deregister the professional corporation for a day when professional services are not being provided, and then re-register it the following day. So again, be mindful of which jurisdiction you're in, and generally speaking, they are permitted.
Excellent. Thanks for that, Tim. And that I'll just about conclude our presentation here. Thanks again to everyone for joining us, and we hope that you can take away some interesting facts. Thanks so much. Bye now.